Satish Ramanathan now joins us. He joins us all the way live from Chennai. Satish, I know you track Infosys with the magnifying glass. You've owned that stock in the past. What is your sense? Do you think these numbers surely will go down very well with markets?
These numbers are a positive surprise, no doubt. The second thing that we need to understand is, given the overall macro, the issue is not which IT stock to hold, but how much of IT to hold in the portfolio itself. And Infosys is reasonably priced. Growth numbers may fluctuate from time to time, but the safety of the stock is something which one needs to look at, and the valuations of Infosys have been reasonable for the most part of the last year. So I think it merits some attention.
Satish, what's the view on Infy though, and more importantly the recovery, or rather the anticipation of a recovery post NRN's comeback, when he himself has indicated that it's going to be a long grind up and it's going to take at least 36 months for Infy to go back to heydays?
I think the heydays of the IT sector in terms of significant double-digit growth is something which we need to moderate. The growth expectations need to be moderated regardless of whether Mr. NRN is there or not. And the fact is that it's going to be a challenge. But from a portfolio perspective and from a stock allocation perspective, the IT sector seems very attractive given the currency volatility that we have. And I think that's something which we need to look at regardless of whether the growth is going to be 6 to 10% or 10 to 12%. That really doesn't matter, because at least A, it's positive growth, and B, it's cash flow accretive regardless of whether it is 6 or 10% or 12%. So from an investment perspective, it merits attention regardless of whether it's 6 or 12%.
Satish, if I look at the top three names in the IT industry, for TCS and for HCL Tech, the return ratios may be peaking out. But for Infosys, surely the return ratio has bottomed out. So you do have a situation in the large cap IT basket where one leader is peaking out and the business cycle for the other one is bottoming out.
I think that's one. The second lever that Infosys definitely has is to increase its dividend payout ratio. And typically when companies start increasing their dividend payout ratio, then you have the return on equity going up as well as the PE going up. So there are triggers left for Infosys to improve its valuations from where it is right now.
Satish, 14% up for the stock.
Amazing. But I think it's also something which is becoming a trading aspect of the stock. I think it can sustain, because anyway the IT pack did not rally after the currency move. So what we are seeing is a trigger that will actually set the IT sector on fire. So what we have seen is Infosys doing that job. And I think the IT sector has not moved, therefore we will continue to see a bit of a rally in the IT space. And there a lot of mid-cap IT names also have to catch up. Their valuations remain the same, and earnings have not been revised along with the currency move.
So Satish, maintaining their guidance, a 300-point move on the stock, does this command a re-rating at this juncture? And do you think it's only a time when we will see most brokerages come out and re-rate the stock and upgrade it to a buy perhaps?
Maybe not a buy, because the stock has already moved today. So, but having said that, it is in a range of 12 to 14 PE, and the trading range can now move to 14 to 16 PE because of the fact that it is a free cash flow, high dividend yielding stock, which can, or rather potentially higher dividend yield stock. I think this is something which market will take cognizance.
Satish, let's talk about the risk-reward ratio. Now, whatever could go wrong for Infosys has gone wrong. And for TCS and HCL Tech in last 2 years, nothing has gone wrong. So do you think somewhere the risk-reward ratio stroke the valuation cushion is favorable for Infosys?
I think we need to bear in mind that there is still management churn at Infosys. It's still early days. Typically, when there is a management change and top leadership change, the results are felt only 12 to 18 months from then. So it may be a little early and premature to count management change as a trigger for re-rating Infosys. One. The second part of it is the industry dynamics still have not changed. And to win incremental orders, Indian companies are hungry for growth. They are willing to cut prices. And it may even get accentuated because of the currency fall. So that's something which we need to bear in mind. And the third aspect for Infosys is whether they will step off the pricing policy and become competitive in the marketplace, which means that their margins will also regress towards the mean and could fall a little more than what the street expects. So these are the aspects that we need to bear in mind regarding Infosys. That said, as I said, the money allocation across portfolios towards IT and pharma is increasing. Therefore, all of these stocks will perform in the short to medium term.
So Satish, I mean, looking at the way the Infi stock has moved today, how the company is performed and their future outlook, is it time to buy TCS in anticipation of what an already good company may do?
I think TCS is already trading at premium valuations, so you may not get the kind of upside that you saw in Infosys in TCS. TCS has demonstrated a phenomenal management ability to continue to outperform its peers. And I think we can bet on that and hold it for the medium to long term. The second aspect about TCS's stock performance was that it was traditionally underweight across all portfolios because of the free float and because of the perception that it may not perform, its growth may not be as high as that of Infosys in the past. That perception has been corrected to a significant extent, and you today have TCS trading at a 30 to 40% premium to that of Infosys. And today TCS's market cap is almost twice that of Infosys, and that's something which we need to bear in mind. So therefore TCS is a high PE stock which will probably perform in line with its growth expectations, and any underperformance will be treated pretty severely in the case of TCS.
Yeah, that's what I think is the most important differentiator what Satish pointed out, that TCS is trading at a very substantial premium to Infosys, and in last 2 years nothing has gone wrong for TCS. So if they slip a bit, the market reaction really could be very harsh. So Infosys is the big story, and that really is fueling momentum in the IT index and which is helping the Nifty. Satish, but what about the broader market? What about the banking sector, the auto sector? Are you a bit surprised with the resilience what Indian markets have exhibited of late? Rupee has gone from 55 to 60, crude's gone up from 97 to 103. There is a big question mark when it comes to liquidity, and markets are still holding on.
Markets, yes, they have been holding on, especially the large cap names have held on. But the mid cap and the small caps stocks have been smashed quite a bit, and that's not getting reflected in the market numbers that we see. To that extent, I think markets been holding on thanks to the overall ETF flows that we've seen, and to some extent there's been a revival in the domestic space as well. So to that extent, I think markets are holding up. and I think that's a bit of a positive surprise.
So Satish, sectorally and stock-wise, what is it that you think is going to outperform and keep the market afloat from here? We're seeing trading moves in the entire banking pack after having been beaten down all of last month. Today is a one-odd day where Infi is really leading the market higher. But generally, do you think we are going to see strength remain in the strong sectors which are fundamentally riding high, the likes of a pharma, for instance, wherein you do have Dr. Reddy's, Lupin, Cipla's of the world, which are making fresh highs day in and day out and do stand to benefit from the currency as well?
Yes, I think this trend will continue. Very clearly, the country is facing a current account deficit crisis. And what we are going to see is the export houses to do much better than what they have done in the past. Their competitiveness has increased, not only due to India's rupee depreciation, but also because of the yuan appreciation. So if you look at yuan versus rupee, there's been almost a 50% drop in the value of rupee versus the yuan. And that trend is going to continue to help Indian exporters over the medium term. And therefore, I think it's probably the export houses that will continue to outperform over the next 6 to 12 months, maybe even longer.
Satish, whereas we are getting excited about IT, Infosys, TCS, Wipro, HCL Tech. Look at the Bank Nifty, which is the heart of the market. The consensus on the street is that the Bank Nifty has hit some kind of a stumbling block. When I say Bank Nifty, banks have hit some kind of a stumbling block. What is your take?
I think bank valuations, especially that of the PSU banks, are very, very attractive. But in terms of the earnings momentum, there could be still some negative surprises coming through. And therefore, in terms of earnings surprise, positive surprise would come from the export sector and negative surprise could come from banking sector. If one has a medium to long-term allocation, then banking would make sense. But if one is looking at a tactical allocation, then clearly export houses make better opportunity, give a better opportunity.
Okay, Satish, good having you on the show and really appreciate you taking the time out and joining us.